So welcome everyone. Welcome to Sustainable Finance Lab webinar on a green interest rate for the Eurozone. My name is Brenda Kramer and I'm the Director of Sustainable Finance Lab since June last year, and I'll be hosting this webinar for you today. Before I dive in, let me briefly introduce Sustainable Finance Lab for those who may not be familiar with our work. We're a think tank based in Utrecht in the Netherlands, and founded 10 years ago in the aftermath of the financial crisis by a group of diverse professors, which we still work with. And the aim of our lab is a stable and robust financial sector that contributes to an economy that serves humanity without depleting the environment. And to this end, we develop ideas and provide a platform to discuss these, thus bridging science and practice, as we will be doing today in this very space. Today's webinar is part of our ongoing efforts to drive thought leadership and practical solutions in sustainable finance and central banking. And our latest report, which we will be discussing, is a green interest rate for the Eurozone. It presents a compelling case for using targeted monetary policy to accelerate the energy transition while ensuring price stability in the Eurozone. We have been promoting this idea since 2020 already, with a previous report co-authored by Jens van 't Klooster and Rens van Tilburg, who I just saw join. So welcome, Rens, in cooperation with Positive Money. And today we are discussing our new report, which was the product of a collaborative effort by several members of our team, including Stan Jordan, who will be presenting our reports, Alexander Simic, Rens van Tilburg, Gaston Bronsring, and myself. Stan will report in a minute, but before we will dive into that presentation, I want to heartily welcome both of our discussants, Francesco Papadia and Karsten Brzeski. Welcome to this webinar, and thank you for taking the time to join us and give your reflections on our report. Francesco is a resident fellow at Bruegel in Brussels, where he analyzes and comments on monetary policy related matters. Francesco spent most of his career in the central bank community, so he's very much expertise on this topic. He was the Director General for Market Operations at the European Central Bank until 2012, and before that he worked at the Banca d'Italia and the European Commission. Karsten Brzeski is the Global Head of Macro Research at ING and Chief Economist for ING Germany. And in this capacity, he's an expert in economic developments in Germany and the ECB's monetary policy. Prior to joining ING, Karsten worked at ABN AMRO, the Dutch Finance Ministry, and the European Commission as well. Again, we're really glad that you want to join us today. Before we kick off with Stan's presentation as lead author of this report, I would like to remind you that this webinar will run for 1 hour. And you can submit your questions using the Q&A module. The webinar will also be recorded and available online after this hour. On that practical note, I would say let's get started. Stan, the floor is yours.
Thank you very much. Let me manage to share my slides. Yes, can you confirm you see it? Brenda, can you confirm? Oh yeah, I see. Thumbs up. Sorry, I need to. Okay. So yeah, thank you very much for the intro, Brenda, and thank you very much for everyone for joining. So my task and challenging task today is to summarize in less than 10 minutes what we did in 10 months of work. So wish me luck on that, and keep Brenda will keep an eye on you if I'm over time. So just before starting to really dive into the green interest rate proposal, I'm just gonna run through 2 elements of context, because I think the audience of this webinar may not be equally familiar with all the concepts we're gonna talk about. So the first element of concept is to remember ourselves that during the 2014 to 2022, the ECB has developed massive lending programs to banks, the so-called TLTROs. And those were meant to stimulate the economy when inflation was too low at the time. And a key feature of this TLTRO, and a very innovative one, was that the interest rate at which banks could borrow from the ECB was basically the level of this interest rate was depending on how banks lend to the economy. So, for example, during the COVID period, the condition was that if banks don't diminish their lending to the real economy, then the interest rate would be as low as -1% instead of -0.5%. So this was really an innovative and first time that any central bank did something like this. And this is because this is why some people have called this a dual rate policy, because effectively there were two different interest rate levels depending on the bank lending behaviors. As I said, those operations were quite massive. They peaked at 2.2 trillion in 2021. But actually, at the time as we speak now, they have been fully repaid. So perhaps you can think this is a story of the past. But the ECB also announced that in the next few years, when excess liquidity in the system will diminish again, the ECB will introduce once again structural lending operations, structural refinancing operations, I said. And as part of that, they will aim to include climate criteria into those operations. So that's very much in that perspective, in that horizon, that this proposal, we're trying to bring this proposal again of having a green aspect in this operations. The second element of context, which Brenda has already spoken a bit, is that, well, the idea that central banks should take care of climate is not really new. I mean, in 2020, the ECB has started a big debate on whether and how they could involve green aspects in their work. And this resulted in an action plan that the ECB released in 2021. And in this context, as Brenda has mentioned, Sustainable Finance Lab and Positive Money teamed up 4 years ago to make this proposal already. And this proposal actually met with encouraging words from Christine Lagarde, who said that the ECB should definitely look into this proposal, but eventually was not picked up in the final conclusion of the strategy review of the ECB. And the main reason for that was the lack of reliable data and definitions on green lending. And this was particularly because at the time, the EU Taxonomy was not finalized, which is why the motivation of this paper was first to revisit the feasibility aspect of a green TLTRO policy, looking into what taxonomy data we have at this point coming from banks. And starting from last year, banks have started to report on the taxonomy, so this is very much operational. So we look into that. But the second and perhaps even more important motivation for this work was that we have just been passing through 2 years of high inflation in the Eurozone and in the EU at large, and this inflation was mainly driven by energy prices. And this phenomenon that we've seen raises important lessons for us. And we think those are reasons to actually, those are reinforcing reasons why a green interest rate policy would be appropriate. The first point is that I think everyone can acknowledge and agree that the fact that, if we had been more advanced in the transition, if our energy mix had been more clean, and if we produce more energy at home with renewables, the Eurozone economy would not have been so exposed to the energy price shock following the war in Ukraine. And basically, if we didn't have to import all this Russian gas, we would be in a much better place, and inflation would have been lower. The second point from that is that when the ECB decides to raise interest rate in response to this energy-driven inflation shock, what it does obviously is not really addressing the EU dependency on Russian gas or other imported fossil fuels. However, this does make capital-intensive investments such as renewable a lot more expensive. So one point of view is to think that actually raising interest rates in this context can be a bit counterproductive, and more than a bit actually, to the financing of the transition. Of course, it's warranted for inflationary reasons, but it's also having a wrong side effect. So in a way, there's a dilemma here that we should look at. And our view is that basically this reveals that the one-size-fits-all policy framework that all central banks have is ill-equipped to face certain types of shocks, such as the one we've seen. And the risk going forward, because it's not just an issue of the past, the risk is that going forward, this will create a sort of stop-and-go effect where if we see more energy shocks, then the ECB will raise the interest rate again, and it will slow down again investments in renewable. So the risk is to create actually sort of instability in the financing conditions for the transition, and so we should try to avoid that. So the proposal that we're putting forward as an attempt to find a solution to this dilemma is to have a green interest rate. I suppose that doesn't come as a surprise. The way this proposal would work, and this is much a simplified version, but basically the idea is that banks could borrow from the ECB up to the volume of their taxonomy lending that they have originated the year before. So if a bank has issued 10 billions of taxonomy aligned lending, and for example in 2024, then that means in 2025 this bank can borrow 10 billion, and this borrowing will be made as an interest rate that would be 100 basis points lower than the normal interest rate. So that's first stage. The second stage is that at the end of the period, if the bank has achieved a certain performance benchmark that to be discussed and defined, but if banks have done a certain lending performance in green lending, then the bank would benefit from an additional bonus, let's say minus 50 basis points. So this would come on top. So a bank that has issued important lending and would effectively be able to borrow at minus 150 basis points below the normal interest rate. Okay, that's really the core of the engine. Of course, there are many of the parameters that I don't have time to discuss right now, but collateral rules, maturity, how long would be this program, all these issues have to be calibrated in order to fit with the monetary policy stance of the ECB. I guess we can return on this during the Q&A. An important point is to make is that this green interest rate would always be set in relative terms to the main interest rate. So if the ECB wants to raise interest rates, no problem. The green interest rate could raise also a bit, but there would still be a differential. To put things into perspective, recent ECB research has found that there is already a sort of greenium, if you say a green spread between dirty firms and low carbon firms of around 14 basis points. So that's already priced in by the market. Now the question is how big should this green spread be? Yeah? And if you read the Draghi report, it is suggested, page 283, that in order to achieve 4% of GDP investments as proposed or as prescribed by the Draghi report, we will need to lower the cost of capital by 250 basis points. So this gives you a bit of a range of magnitude of what would be useful for the economy and for the transition. Okay. As I said before, the key aspect of this report was to look into the taxonomy related data that banks are now disclosing. So I will spare you the details now, but just to tell you like the methodology, what we've done is that we actually analyzed 73 banks. So we looked at their Pillar 3 reports where they are disclosing since last year their taxonomy alignment. And this gives you a snapshot, but I really don't have time to go into detail. So let me go straight to, what can we conclude from that? So basically at the end of 2023, bank held around 400 billion of taxonomy aligned assets. 3/4, I think if you look at the picture here, 3/4 of that, 76% are mortgages. So really the big part, the lion's share is mortgages. Now we know that under the TLTRO program in the past, the ECB typically excluded mortgages from TLTRO, and they also excluded financial corporation loans. So if we exclude those two things, this leaves us with 65 billion of eligible assets. Now, this 65 billion of eligible assets, this is the stock as of end of December 2023. Now, the purpose of the Green TLTRO program would be to reward the flow of lending. So actually, what matters is how much lending has been originated in 2023. So we don't have that exact figure, but by proxy, if you assume that the maturity of corporate loans portfolio is around 5 years, which is what we observe based on the data we have, then that basically means that if this portfolio is renewed by around 20% per year, which is a very approximation, but this results in 13 billion of loans, of lending that would have been eligible to a Green TLTRO program as of 2024. Okay, so this is a bit of a simulation, but what this tells us is that if the ECB had started a green interest rate program last year, the amount of the volume of this program would have been around this number. And actually, what's interesting is that 30 billion is actually lower than how much banks are currently borrowing from the ECB using not the TLTROs, because these don't exist anymore, but using the normal refinancing channels, namely the main refinancing operation, MRO, and the LTRO. Okay. Now, this all I just said is assuming the entire scope of taxonomy activities would be covered. Now, if you remember the story I said about, okay, it's about energy decarbonation and everything. So basically, if you wanted to have this program to be a bit more narrowing down to specific segments of the taxonomy, such as energy decarbonation, because you would think that these investments have more disinflationary power or potential, then of course this would reduce even more the volume of this program. So the key message here is that at this point, of course, we all hope that taxonomy, the share of taxonomy aligned lending will grow in the future, but at this point, the taxonomy lending in the banking system is so small that it actually makes it feasible for the ECB to start this without compromising its price stability objective, or without expanding too much its balance sheet, if you like. Okay, so to conclude, the data availability issue that the ECB has pointed out a few years ago when considering its policy is not really an issue anymore, we think. And you know, if anything, having a green interest rate policy to reward taxonomy alignment and reporting would only increase the efforts that banks would make in order to collect data and in order to make sure these data are good. So we really think this is not the main issue anymore. As we've seen, the amounts that could be potentially eligible for this program are pretty reasonable at this stage. Now, to add a bit of element in the context of the omnibus proposal and the fact that, you know, the EU Commission is proposing to shrink actually the number of corporates that would be that would have to report on their taxonomy alignment. Actually, having a policy like a green interest rate that would reward companies that are investing into ESG reporting, into CSRD, even on a voluntary basis, would seem like a good idea, because this would actually compensate the fact that if we're going to shrink the number of companies having to do this, then we should still continue to reward companies that make the effort to do that voluntarily. Okay, so that's maybe an element for open discussion. And so really to conclude, and perhaps this is the main conclusion and in a way to pass the baton to Francisco, I think there's a convergence of objective between the EU strategic autonomy objectives of the EU, and namely having an energy mix that is more domestic and being more autonomous on our energy production thanks to renewables. This is a converging objective with price stability. So that's why we should think of energy policy, climate policy, monetary policy a bit more together. But where I guess we agree with some of our critics, is that doing so would require a higher degree of political legitimacy for the ECB, because this is indeed the type of policy that is more proactive than the sort of risk-based policy that central banks are already doing. So in that sense, we certainly need a more democratic debate in order to ensure that indeed it's the role of the central bank to go in that direction. Okay, I'll stop here, and thank you very much. I'm looking forward to the Q&A.
Thank you, Stan, for this very short and great presentation. I would now like to turn to Francesco for your brief remarks and your feedback on the paper. Francesco, given your large experience, we would love to hear what you think about the proposal, how feasible it is, and and is it compatible with the ECB's mandate and the independence framework? The floor is yours.
Thank you very much. Can you see my slides?
Yes, we can.
Very good. So first of all, many thanks for inviting me to discuss this interesting paper, interesting and very topical. I have three preliminary points before I address the substance of the issue. The first one is that I'm fully convinced that it's urgent and very important to do something for climate. There is no question in my mind that this is one of the top. Of course, until recently, it was at the top. Now we don't know whether war and Putin and Trump are the top, but still, it's very close to the top of the problems that we have to deal with. And I also think that the ECB can and should do something about it. So it's not only that this is an important topic that has to be considered in general, but I think that this is also a topic where the ECB can do something. Now, my second preliminary point, that if, and in my notes, the if is in bold character, if you want to do a green rate, the paper by Stan and his co-author is a very good way to address the issue. It's very thorough, is very precise. It's new in some parts. It's very accurate. So if you want to do a green TLTRO, well, you are well advised to start from this paper. Also because it has quite ingenious way to deal with the limited amount of data that is available. The third preliminary point, which is of an order of importance less than my first two, is that some of the urgency in the paper from the fact that interest rates are high is no longer there. Interest rates are no longer high. When the paper was written in October last year, yes, rates were high. They're not high anymore. So some of that urgency is not there anymore. But again, this is not of the same degree of importance as my first 2 points. So let me come now to my 5 criticisms. And I will just list them in the slides, and then I will go through them one by one. The most important one is that I don't see that the ECB has an advantage in incentivizing green investment. So if you think of an assignment where each entity should take care of the topics on which it has an advantage, I don't think that the ECB has an advantage in this area. And this is my most important criticism. My second one is that with the discount that is foreseen in the paper, we would go down to 0 or maybe even lower than 0 interest rates. And we know that negative nominal interest rates were needed during the crisis, but we also know that this is an unnatural development. I mean, we know that there are problems with resource allocation, there are problems with the financial stability with negative rates. So going down negative, even if for a part of lending, is an issue. The third criticism is that adding more losses to those already incurred by the ECB, and by the ECB, I mean the Euro system, is an issue. It's already something of an issue that they're running so much losses. You don't want to add to this. My fourth criticism is that you reinforce the banking intermediation channel. So this is a way, while capital market union, you could say, serves to increase the capital market intermediation. In this way, you further reinforce the bank intermediation channel. My last point has to do more with my Weltanschauung and has to do with the fact that I'm hesitant to think that central banks should do resource allocation. Okay, let me come then to my first point, expand a little on my first criticism. So basically the paper says maybe you have some 5 billion to incentivize green investment. Then my question is, why do you want to give this 5 billion to the Euro system? Why shouldn't the government use this 5 billion? And I don't think that the ECB has, as I said, an advantage as an advantage here. There is a lot in the paper about the help of the taxonomy. But my reading of the taxonomy is that the taxonomy is a very difficult tool to use. It's nothing like a manual. It's not something that you go there and you find an easy answer for all your questions that you have about classification of investment and as green or not green. Is you need specialized knowledge to use the taxonomy, specialized knowledge that the ECB does not have and does not need to have, because I mean, this is not, but well, the government has that specialized knowledge. So in my sense, it would be much better for the government to do this than for the ECB to do that. I also believe that the practical use of the taxonomy so far has been very limited. I mean, the hope that the taxonomy would become the most important tool for green investment, I think, has not come true because of what I said about the complication and the specialized knowledge that is needed to use the taxonomy. And of course, in his presentation, Stan referred to the fact that the information that will come from the taxonomy will be further reduced because of the new simplification policy of the European Commission, of the European Union, that will substantially reduce the amount of information that firms will have to deliver because of the taxonomy. And I think that in a way the paper recognizes this when it says, well, maybe a variant would be that the ECB would choose among the taxonomy those that are most important. So most important for the climate. So once the ECB should go one step further and interpret the taxonomy, not just use of the taxonomy and say, okay, I will finance this because this is more helpful for climate than for that one. So I think that in the paper itself, there is a recognition that the use of the taxonomy is complicated. So the information basis for a green interest rate is uneven and limited, even with the taxonomy, difficult to use. The ECB does not have the competencies to do it. Now, going back to zero interest rates, again, this was something that nobody thought was possible before the crisis. Then it was possible, but still, I think possible with a cost. And you don't want to go back to that unless you are really forced by inflation development. So that is an additional disadvantage. 5 billion, the paper says, okay, well, the Euro system already has 160 billion of losses. Does it matter so much that you have another 5? Well, I would say, well, yes. I mean, the fact that it's losing money is not a good reason to lose some other money, even if it's not a lot with respect to what they are already losing. So these 5 billion, why should they come from the Euro system and not from the government? And then reinforcing the bank intermediation channel. As I said, I mean, capital market union, we want to increase what the capital market does. Here, we put an additional incentive for moving to bank intermediation. And the government, instead, when it does the use of this 5 billion, could very well do it in a neutral way, not necessarily incentivizing bank, but incentivizing maybe the capital market. Then my last 2 points are connected. Once you start thinking that the central bank should do resource allocation, then you can say, well, there are so many things that resource allocation could do. And my youth as a central banker was in a country like Italy, which did a lot of direct controls, did a lot of resource allocation, At that time, it was to help the public sector to fund itself. Maybe now it's the opposite, is to help the private sector to help itself. And by the way, this was what the philosophy behind the TLTRO. And I would admit that the ECB has already gone somehow into this resource allocation business with the TLTRO, because it's a said, like Stan said, oh yes, we will incentivize lending to the private sector, but not to the mortgages, because we don't like the mortgages. I don't know for which reason we don't like the mortgages. So DCB has already gone on that way, but I wouldn't wish that it would go further on that road. I have to justify the fact that I think the ECB should do something. So if I say no to a green TLTRO, I have to say something positive. What else should the ECB do? It should interpret what support means. For instance, I mean, are we sure that the ECB properly takes into account climate issues in modeling and in economic analysis, especially when it comes to inflation forecast? Then are we sure that the ECB is doing what it needs to do when it comes to bank supervision, not monetary policy? So I think these are the path that should be followed to give concreteness to the support of the ECB to the other objectives of the Union, including the climate. So in conclusion, I'm not convinced that the ECB should start a green TLTRO program, and I would look instead for other avenues to give content to the support prescription of the treaty. Thank you very much.
Thank you, Francesco, for this insightful presentation. I'm sure Stan can hardly wait to react to some of the points, but we will first move to Karsten's remarks. And also I posted something on the questions and answers. Should you have any questions, please put them already up. So there's some time for questions after Karsten's remarks. So feel free to post anything you have. Karsten, the floor is yours.
Yeah, thanks, Brenda, and well, thanks for inviting me. Great discussion. Well, also great remarks by Francesco. It's hard, actually, Francesco, to really disagree with you. But you know, I think we're always very good in Europe in finding, you know, some problems or some arguments why not to do the stuff. And of course, the ECB does already green stress testing. They talked about changes of collateral rules, but I still feel some sympathy for this green TLTRO story. And yes, we know that data collection is a big issue. And I'll start with a few additional, because we can find so many problems in terms of implementing it. And another one that I was thinking of that you didn't touch upon, Stan, is how do you actually make sure that, and I'm supposed to take over the perspective of the banks here, how do you make sure that actually banks are charging their clients lower interest rates, so that they're not using the green interest rate and to widen their margins? That is also something else. I think if you really want to go into kind of the real economy, lending growth, you would also need to make sure that there are, I don't know, caps on margins, yeah, but to really make sure that this green TLTRO or the green interest rate is actually reaching the real economy. That is one aspect. But I'll turn around and said, you know, try to be a bit more optimistic, and I would go for why not try it? And this why not try it, I would be even more controversial. And I know, you also mentioned it, Francesco mentioned it, the ECB always excluded mortgages from the TLTRO. And why not turn it around? Why not think of a green TLTRO only for green mortgages? Because when you look at which parts of the economy are really highly sensitive to interest rate changes, it is mortgages. It is also customer or client behavior. I'll give you an example. ING in Germany is already offering now lower interest rates to our customers if they renovate or modernize their house, their apartment. And also when it comes now to this housing stock, well, we do have energy efficiency labels. So why not turn around and, because we have all these problems if you go into industry, and then it's about documentation. It's really about making sure, well, would a customer really, well, go for the green interest rate if it's only a few basis points lower? Is there really enough demand? And of course, that's the point Francesco is making. Well, should it be up to governments to create then more demand? I could also say, well, I would favor the green TLTRO, because there you leave it up to the market to decide on where the money is going to, and not leave it up to governments to actually decide on where now support for the green transition should be. But to come back to my point on the green mortgages. So why not? If this is a very kind of targeted instrument, if you also think that where is the biggest chunk of CO2 emission actually coming from? It's still the housing stock. It's still the housing market. So why not turn around and think of this idea of a green TLTRO, which could then be an incentive for the banks to also offer much lower interest rates for, I don't know, purchases of a highly energy efficient property, or also to modernize and then to create therefore incentives to modernize and make the housing stock more carbon neutral. I think by turning it around, I think it could also make sense. Plus, and then that would be my more supportive argument here. Always saying no and always trying to find some complicating factors is always very easy. But I rather have this idea, why don't we just test it? Why isn't the ECB just trying it? They can always stop it. And the TLTROs were also expiring. So I think that is clearly something that I think, well, let's give it a try and just implement it. Final remark, and of course, the way you constructed it is targeting a very small stock in the economy. So therefore, you could say, well, it won't be inflationary or disinflationary. From a monetary policy perspective, of course, the problem or one challenge of any kind of two-tiered interest rate will always be that it could become countercyclical at some point in time. So I think that is something you also need to take into account. When we had the TLTROs by the ECB, we were in a zero interest rate environment. If you look at the current situation, where an ECB tried actually to dampen inflationary pressures, then would offering a two-tiered interest rate really have made sense? Well, it runs the risk of becoming also a kind of pro-cyclical. I think that is the reason. Well, like Francesco said, where we are right now with interest rates back down on their way down, well, a two-tiered interest rate could make sense. But also there with the question of whether customers or clients in an environment of low growth would really make the interest rate the most dominant variable in their investment decision. I think that is also an interesting. So bottom line here is I really like the idea. I like the concept of the idea. I would love to see the ECB just trying it, and I would open, I think, also your thinking more towards the real estate sector, mortgages, rather than other industries.
Thank you. That's a very clear message, and Very constructive. Thank you. Stan, I can imagine you are eager to react and respond to these two reflections.
Yes, indeed. But there's a lot to say, so I'm going to maybe pick and choose for now, and I'm sure we'll return some of the point in the Q&A. I think the most fundamental question that Francesco asked is, is it the role of the central bank to do this thing? I think yes, to some extent, because in a way, first of all, I know people in the ECB who are more than experts on the taxonomy, so I think the expertise is not completely absent in the central banks, but that's just a side point. The more fundamental point is, I think the central bank sits right now in the middle of their supervisory role, where they get a lot of information from banks on their balance sheet, on lending flows, and now on ESG factors as well. But they are also at the same time the ones channeling money to banks. So I think actually they're exactly at the crux of the system, where I think the tweak we're proposing is pretty simple. So in terms of like cost optimality of this measure, I think the cost of doing that would not be so huge compared to some seriously complex government programs, and I know quite well the French renovation subsidies. They are super complex, not necessarily reaching the right people. So I'm not a big. I think we should not fantasize the optimality of fiscal decisions as well. And as Carsten has said, certain market-led mechanisms can also be very effective in channeling money in the same place, in the right place. So I think there's this kind of cost efficiency argument that actually central bank with that measure will have a huge impact with actually quite limited bureaucracy. And of course, this assumes that the taxonomy works well. I understand your criticism, or at least your pessimism. I think this pessimism will go away. I mean, first of all, we have a big discussion right now in Brussels about simplifying the taxonomy for perhaps good and bad reasons, but I think we will get there in terms of getting the system to work well and better. I think if a lot of people are working on this, we will manage. So I think we should look beyond these pessimisms. Otherwise what? Have we done all of this work for nothing? And in a way, I think I would even say that I think part of the reasons why this whole debate on CSRD and taxonomy is a bit stuck is because there's no carrot at the end of the road. So we're asking a lot of enterprises and companies to do all this work collecting data. I mean, a bit for nothing, or at least just maybe for reputational reasons, but not for the hardcore business reason, which is if you do this, your cost of capital will go down, and therefore it's good for you to do it. So in a way, having a green interest rate will be a catalyst for actually improving the framework, make it work well, and so on. The other smaller point, I mean, it links to also what Carsten has said about, okay, actually which segment of the taxonomy are relevant for this issue, for this program, or should the whole range of taxonomy? So first of all, when a small correction from what you said, Francesco, in the paper, when we discuss like this selective taxonomy approach, we call it, this is more having in a view of like actually having monetary policy objectives in mind more than maximizing the climate benefits, if you like. So for example, when we say, you should concentrate on energy sectors and maybe leave out mortgages, this is for price stability and financial stability reasons. So that would be more like the way of thinking rather than the ECB thinking, prioritizing climate reasons over its own mandate. So let me be clear on that. But this raises also Carsten's question, and so there I could not really dwell into that in my first presentation on the mortgage. So I just conveniently said, the ECB exclude mortgage, therefore we should do it. But actually, there's more fundamental reasons. But I think we will eventually agree on Carsten, because indeed buildings is super important. So I think the distinction we have to make here is having a green interest rate for mortgages that basically are just paying for purchasing a home. And the taxonomy rules say that, okay, if you buy a house that has a high energy performance, then it's taxonomy compliant. Okay, but if that house is already green, does it make sense to give a subsidy for people to buy more green homes? There will be a shortage of these homes anyway. So in a way, you would create a sort of green bubble on green homes. So I think the distinction we have to make here is that we should not really give the green interest rate on mortgages for green homes. What we should do instead is give a green interest rate for renovation loans, or for the in the case where someone buys a house and has to renovate it fully, in that case, you should take into account the cost of renovation in that mortgage. And that particular cost, so either you renovate a house that you already own and you fully pay the mortgage, you just need maybe 50,000 euros to renovate it, fine, renovation loan, green interest rate on this. If you buy a house that you have to renovate fully and maybe the cost of the renovation will be a third of the mortgage, then that third should be indeed eligible for the green tax. But I would not subsidize the entire mortgage, because in that case, you would actually not really help reducing carbon emissions, because you would subsidize homes that have already a high performance, and you would also subsidize people who are able to borrow to buy bigger houses. So I think there's a bit of a distribution of consequence there. But so I think if we just go a bit more into details, I think we can certainly find a way that such a policy would indeed accelerate the decarbonation of the building sector. For sure, that should be one objective. And one final element maybe on the bank intermediation point. Again, this links to okay, which sector should this policy benefit most? You know, a lot is being said right now on capital markets and so on, but I still do not think capital markets will play a big role in certain segments, especially actually just the one we mentioned, buildings. I don't think tomorrow you and me are going to buy a house by issuing a bond that we're going to securitize on the market. We will always go to a bank to get a mortgage. This will not change tomorrow. And same for car loans. The decarbonation of the automotive sector could be also you know, like this retail segments of this retail segment of the financial flows that we need to generate in order to transition the economy. Banks will still play a big role in there, a dominant role, and so we should not have too high expectations that the capital markets union will solve every single segment of the market. Retail markets, banks still play a huge role there. And actually, that's something like Joachim Nagel said this exact point in a recent speech, that banks will remain an important player for retail investments. Okay, there will be more points to answer, but let's maybe turn to the Q&A.
Thank you, Stan. Yeah, that's a great idea. Thanks for this reflection. One of the questions that came in would be about something that was very intrinsically linked to the taxonomy, which is the EU Green Bond Standard. And how could that play a role in potential future asset purchases or collateral policies, for example? Could the ECB, for instance, apply lower haircuts on EU Green Bond standards that are compliant to sovereign green bonds and also the Commission's next generation EU Green Bonds? And how large might these measures have to be to feed through if you would go this alternative route? I was wondering, Karsten, can you say something about that?
On the green bond story.
Yeah, so how that channel, how could it?
Yeah, listen, I'll just give you some examples of discussions that we have with clients on the green bond, and then we love green bonds. We're also very happy in helping issuing them. But what I often hear from clients is that indeed, due to the taxonomy documentation. So, and I think this is if we were to reduce documentation, it would clearly help also more embracing of the green bonds, in all honesty. Because right now I very often hear, especially from large corporate institutions, saying that the interest rate gap is so little that it's not worth actually going through all the hassle of the documentation.
And if it would work, if we had a good green bond standard, how could the ECB play a role, for example, by applying lower haircuts or?
That would exactly. Then we are indeed in the collateral theme again, and this could be the ECB then applying lower haircuts. Yes.
Yeah.
In the collateral framework.
Yeah, exactly. Do you agree, Francesco?
But Francesco's markets expert, so he knows everything about it.
Let me introduce some practical comments. I mean, one of my tasks since I left the ECB is being chair of an organization that helps issuers to issue securitized assets that respond to certain characteristics, which is called STS. And we are now a regulated entity in doing this. And we thought we would extend our activity to green asset-backed securities. And we looked into it, and we realized that there is no practical way to go because the European green bond is too complicated. So I just confirmed what Bresky said. I mean, so we would like to have green asset-backed securities, but there is just no interest because it's so complicated. And this is connected to the taxonomy. And then, of course, when you simplify it with the omnibus, and then you realize that you reduce the information that is available for classifying assets. So it's a very complicated issue.
Does that just account for the green bonds, the EU green bond standard? Because there's the green bond principles, for example, like other frameworks that are already used. How would you see a role for those frameworks, or are they too voluntary?
Well, I mean, there is a little more success for other than the European green bond, but still very limited. And of course, when you have a plurality, then it's difficult also for an investor to say which one should I follow. So I'm in favor of something official, but this something official should be thought with more of a practical sense.
I agree. Okay. I have another question to you, Francesco. Would the rate incentive from the ECB not be amplified by financial markets through lending?
Well, maybe this is more a question for Bresky, because he said, how do we make sure that the banks just don't pocket the
exactly
and increase their margins? And of course, since, with all due respect to Bresky and bankers, we know that the banking system in Europe is not very highly competitive. This could indeed happen. So instead of magnifying, we have to make sure that they don't minimize the discount, so to say.
Carsten, how do you assess that risk? Because I think it is indeed one of the things that could happen.
Yeah, like I mentioned at the start, I think it's very, very hard to comment on that, because I don't see how the ECB would actually control it.
No.
So you could only argue it would come via competition. I wouldn't say, Francesco, actually, that the European banking market is not that competitive. I think you could argue it's not always very profitable, and that because there is a high number of banks out there. You know, in all honesty, I have to give it to the answer to this question is there is no way that the ECB can actually control it.
No. That's one of the complications I think we already indicated as well in our discussions amongst each other. Let me see. There is one more question about the issue of central bank losses. What limit is there really on central bank losses, such as adding to losses via a green TLTRO system? Like, would that really cause a problem? And even if it is a problem, is there an argument that a green TLTRO loss represents a better loss for the euro system to make, given its more targeted nature?
Well, if you ask me, the question of the profits or the losses of the central bank is an infinitely discussed issue, because on one hand, it's true that a central bank can incur losses. A central bank can implement its monetary policy even if it has losses, even if the accumulation of losses leads to negative equity. So on one hand, this is true. On the other hand, there is a sense that why should they lose money? I mean, they have an enormous amount of financial assets. Why should they produce a negative return on these financial assets? And then maybe connected to that, is there not a reputation issue? So why is this a central bank running its business so that it loses money? People could ask. So I'm not saying that losing money is the death of the reputation of the central bank, but if you manage to make some money out of the enormous amount of resources that you have, that's preferable. And given that you have losing already so much money, is not an excuse to add to that. So it's I realize I'm not giving you a fully fledged and clear answer, because the topic does not lend itself to a very precise answer.
Thank you. And I think also, with an eye on the time, we are bringing this discussion to an end. I am really glad we had over 100 participants with this webinar. So even with all of the things happening around us, there's a lot of interest in driving climate and the role of the central bank in that. So it's at least how I interpret it, and that's a positive sign, I think. So keep showing up, I would say to all of you. Thanks again for Stan for your presentation, Karsten and Francesco for your excellent remarks. I think it was a good debate, always good to have different views in a panel. And with that, we will come to the end. I also like to thank the participants and, of course, my team for organizing this great webinar. If you would like to dive deeper, the full report is available on our website. And I think in the chats, we can put the link. And then if you want to contact us for further information, we're, of course, always available to have a chat. Thank you all for your time, and we look forward to seeing you at future events of SFL, and wish you a very great day and week. Thank you all.
Thank you.